Hi, I'm your AFM expert tutor, Andrew Mower. Now, my students always love the way that I take really complicated concepts in AFM and make them simple and easy to understand. So I designed and built my online AFM course to do exactly that. Break down those really tricky topics into simple steps. So here's a little video, which is from my course. This is from the tuition phase of the Platinum AFM course that I offer, which includes both tuition, revision, and 2 marked mocks. But this is an actual module from that course looking at the dividend policy. So you can see exactly how I explain concepts. You can see how I love to relate them to the real world as well and make them visually appealing and fun to learn. So enjoy the video. Now it's time to think about dividends. So in this video, we'll look at the dividend theories, some practical factors when deciding how much of a dividend to pay, and then some dividend methods as well. So let's start by looking at the dividend theories. There are 2 real schools of thought here. Some people say dividend policies are irrelevant. It doesn't really matter to investors how much of a dividend they pay. Other people say it's actually really important. So we've got 2 conflicting views. Let's start with the irrelevancy theory. Now, Modigliani and Miller, our good old friends, say that investors are indifferent as to whether their returns are from either dividends or through share price growth through reinvestment in positive NPVs. So what they're saying is, if you're an investor and you get paid a dividend, let's say of $5, you're happy. You go, great, I got a $5 dividend. Or if your share price goes up because the company, instead of paying that dividend, actually reinvested it in a project and your share price goes up by $5, okay, great. I'm happy either way. So whether I get a dividend or whether my share price increases, I don't really mind. I'm getting wealthier. That's the main thing from an investor's perspective. However, there are lots of things that say actually that's not necessarily the case. And therefore, a company's dividend policy, deciding how much to pay their shareholders, is a really important decision. Now, the first thing to think about is liquidity. Dividends are actual cash in your pocket that you get paid. You can then spend that and do what you want with it. If your share price goes up, that's not actually cash, is it? That's just unrealized profit. It might be that actually the share price then falls again next year. You've got no idea. So there's a lot more certainty around dividends. The next one is around expectations. Some investors expect a consistent dividend policy. Now, this is something called the clientele effect. Some people invest in particular companies because of their dividend policies. So if you start changing that policy, investors will get upset and maybe start selling their shares. So again, it is an important decision, according to this. And finally, signaling. If you change your dividend policy, people interpret that as either good or bad news. Imagine you've always paid a 10 million dividend. 10 million last year, 10 million the year before, 10 million the year before that. And then this year, you announce your dividend, everyone's expecting 10, and you pay 2. People will think, what has gone wrong? This company is struggling, something bad's happening, I'm going to sell my shares. So people see this as good or bad news. And again, if you change your dividend policy, it does have an impact in the real world. So there are a couple of viewpoints. And in reality, dividend policies are important. Now let's think about some practical factors when you're deciding how much of a dividend your company should pay. The first one is this clientele effect that I mentioned. So thinking about shareholders' expectations, what have we paid in the past? If we suddenly change that drastically, we're going to have to be very careful that we communicate that properly with our shareholders. We also need to think about our cash needs. Dividends obviously eat into your cash balance. And you've got to be careful as well. Profits don't equal cash. So it's all well and good saying, we made 50 million of profit this year. Let's pay out a 30 million dividend or whatever it is. But you've got to make sure we've got the cash available. And also we then have enough cash to keep trading over the next year. As we saw a second ago as well, we need to think about signaling. If we are going to change our dividend policy, how does that look to our investors and to potential investors? There could be legal factors. Got to make sure that our dividends are all above board and meet regulations. There could be restrictive debt covenants. So we may have a loan, for example, that limits the amount that we can pay out as a dividend. And we also may need to think about tax implications. If you pay out dividends to investors, they will have to pay tax on that, most likely. So that could affect our policy as well. So let's think about how we can actually pay dividends. The first one is actually a zero dividend. Now, guess what that means? It means you pay no dividends, but instead you're going to reinvest the cash. As I'm going to show you in a second, that is really popular with companies who are just starting up. So if you're a new company, you're going to need that cash to grow, invest in research and development, marketing. You're not going to be paying yourself huge dividends initially. So that is really common for new, fresh companies who are growing. Another option is to pay a stable dividend. So you pay the same dividend each year in absolute terms. So that might be $10 million. You always pay the same dividend each year. Closely linked, but slightly different, is a constant payout ratio. So you pay the same percentage of profits each year to your investors. Now, as you can imagine, that's less predictable than a stable dividend, isn't it? Because some years you'll have more profit, some years you may not have any profit at all. But what that does mean, you can always afford it. The risk with a stable dividend is, if you're always paying 10 million, if you only make 6 million of profit one year, you're going to have to eat into your reserves to pay that. It could really damage the business. Whereas with a constant payout ratio, you can always afford it because it's just a percentage of profits. And also then your shareholders benefit. If you have a great year, they will also have a big dividend. So there's a little bit more of a link between you and your performance and the returns to investors. The last one, which is quite a common approach and works really well, is a residual approach. So this is where you invest in all your positive NPV projects first. Once you've done that, and remember, positive NPV projects help drive up your share price. They make your company better. Anything that's left then will pay out as a dividend. So that's a really nice approach. We're going to take any great opportunities we've got, any cash we've got spare, great, then we can pay it out as a dividend. So that's a nice one as well. Now, there are some alternatives. The first are these scrip dividends. So rather than paying a cash dividend, we offer our shareholders free shares. So that means we retain cash in the business. Now, if you're an investor, you think, oh, great, I've got another share. This is excellent. But all you're really doing is dividing the company up into smaller bits, aren't you? So it doesn't really help from an investor's perspective, but it's something that some companies look to do. There's then also this idea of a share buyback. So this is where the company buys back shares from the shareholders. Now, this is at a reasonable price. They can't just name a really low price and get loads of shares back. And the reason companies do this, it will ultimately reduce the dividends they have to pay in the future. It can alter the control of the business. And it also uses up any spare cash they've got. So we saw this with Ryanair, an Irish airline who do budget flights. They've done quite a few share buybacks in recent years. So sometimes you've got some spare cash, not sure what to do with it, no amazing projects. Okay, great. I'm just going to buy back some shares from our business. So it can work really well. Let's look at a real world example now. I'm going to show you Apple's dividends. So this is Apple, the tech company, rather than any fruit products. And in 1976, Apple was founded. There's a good one in case you do any quizzes. And in 1987, they initiated their first ever dividend program. So started paying out dividends. Now this is where it gets fun. 1995, they stopped paying dividends. So they switched to a zero dividend policy and instead started reinvesting that cash and growing the business. So they started developing new products. Now during this period, they were developing the first iPhone, iPods, all of those products that you now see everywhere. In 2012, so that's 17 years later, they started up paying dividends again. And they started paying quarterly dividends of $2.65 per share. A couple of years later, they increased it. So their quarterly dividend now was $3.29 per share. Then it went up another 10%. up to $0.52 per share. Now, those of you who are good at maths are thinking, hang on, that doesn't add up. 10% higher and we're on 0.52. They did something in that time called a stock split. So during that period, they actually divided up the number of shares they've got. So for every share you had, for example, you may then own 7 going forwards. So when you see these numbers, if they look a bit strange, they'll do these stock splits. So again, for every share you have, suddenly you now have 7 or maybe 8 or 10 shares going forwards. In 2017, it went up another 10.5%. In 2018, it went up by 16%. And then 2020, they increased it up to $0.82 per share, so another 6%. So can you see that period of growth between 95 and 2012, where they didn't invest in any dividends whatsoever? They were throwing that money back into the business and growing. And their share price during that time absolutely rocketed. And anyone who bought shares, like in Forrest Gump, if anyone's ever watched that, at the end where it turns out he had those Apple shares all along, they could have been really, really well off if they'd invested in 1995. Okay, that's it for dividends. So we've looked at those dividend theories, whether they're relevant or irrelevant. We looked at some practical factors which you may have to discuss in the exam and look out for in this scenario. And then we also looked at the dividend methods available to companies if they decide they're going to pay out a dividend. And there we go. There's a video from my Platinum course. If you want to study AFM with me, I'd love to help you pass AFM. So please get in touch. We can discuss the modules that are available, the courses on offer, and I'll help you get that pass in the bag. Thanks for watching.